Mental series. I'm Cheryl Kane Piasecki, and I'm joined today by Patrick Shepard. Hey, Patrick.
Excellent. Hey, Cheryl, how are you doing?
Oh, just excellent.
Great.
So we want to start by sort of apologizing to those of you who tried to tune into our broadcast last week. We clearly had some colossal, fatal technical issues with last week's broadcast.
Our audio driver quit.
Yes. And so, and truly we apologize for that. That was a completely unforeseen glitch that we had. But here we are today, and we're going to reprise what we would have delivered last week, which are recurring reporting issues in public financial disclosure. And before we get started today, I did want to give you all a heads up, though, and you should be getting a listserv announcement about this sometime later this week, if not later today. Next Thursday, on the 27th at noon, our Office of General Counsel is going to join us, and they're going to be discussing the new pledge guidance. I know there have been a lot of questions about that, and we issued 2 advisories on that. And this session is going to be basically trying to make sure that there's clarity in what that guidance is. Right. So for those of you who currently have appointees who have signed the pledge, or who anticipate appointees who will be signing the pledge, I encourage you to tune in next Thursday at noon for as much information as our general counsel can provide in an hour.
Yep. No, I think that's going to be very helpful, and maybe allay some of the confusion. With new policies, it's always good to hear it a few different ways.
Absolutely, absolutely. So if you could bring the slide deck up, Patrick, that would be great. As we said, we're going to be talking about some recurring financial disclosure reporting issues. We have basically come up with a list that is based on questions we've actually gotten from the community. So what we're going to be covering today, we're going to be covering REITs, which are real estate investment trusts. And we're also going to be discussing call and put options, capital calls, confidential clients, inter vivos trust positions. Now, I don't want people getting too excited about that, because we're not going to, I know there've been a lot of questions out there about trusts. I'm going to have Patrick sort of discuss in a minute, why it is that we are not going to take on that subject for purposes of this broadcast. And then we're going to take some time at the very end of the broadcast to talk a little bit about, I know some of you are experiencing folks coming on board that have temporary appointments to like consulting types of positions with the government. But having shown you what our itinerary is, or our agenda, Patrick, you want to just take a minute or two to talk about why we've not included trust?
Sure. And I know there's especially when we have high volumes of new entrant filing, there's a lot of desire to get some general guidance on trusts and private investment companies and things of that nature. And there isn't a lot of broadly applicable guidance. And the reason for that is, these instruments are created between parties. They can be set up kind of however you like within the law.
Right.
So it's frustrating that oftentimes when we see trusts and private equity companies, that it seems like you're starting from zero. And the truth of the matter is, usually we are starting from zero. Aside from saying, the law applies, the requirements to disclose apply, we have to figure out if something's an EIF or not, et cetera, et cetera. That's really as much as there is in the way of broadly applicable guidance. So it's not that we're sitting on the decoder ring for these things
the Rosetta Stone,
and refusing to share it. It's that really, in many cases, we really are starting from zero. So we're happy to work with you. Our desk officer is happy to work with you. But in a format like this, there's really not a great deal that we can share with you.
Yeah, so I mean, effectively, we're talking about trusts typically are kind of one-off situations. And in many instances, pooled investment, private, pooled investment vehicles like, private equity funds and hedge funds are in some respects going to be one-offs as well. But, I'm going to talk very briefly about the current guidance we have out there on pooled investment funds in a little bit. But if you're curious as to why we're not covering, I know those seem to be hot topics in the community. It's really, as Patrick said, there isn't a whole lot we can say as a general proposition. But please do call us, and don't struggle alone with any of those questions that you're having. So we're going to get started with our agenda. And the first thing we're going to talk about are real estate investment trusts. Now, I think that some of the confusion that has arisen with respect to these, both how they're reported and how you treat them for conflicts purposes, is that folks are conflating 2 different types of investment vehicles. So when you are looking at something on a form and it looks like it's a real estate type of investment vehicle, you have to determine whether or not it is actually a real estate investment trust or if it's a real estate fund. And so you may be asking yourself, so what is the distinction here?
Enlighten us, Cheryl. What is the distinction?
Well, a real estate investment trust, and this is just a very general definition that I got from Investopedia. It's a type of security. Okay, so it trades on major exchanges like stock. So it's treated like a stock. It is a security. It's not a fund.
Okay.
Okay.
So it's an ownership interest kind of vehicle.
Yeah, and it invests in real estate. It invests in real estate, either, as it says from the definition, either through property or through mortgages, but it is a security, okay? And that's how we treat it. So it trades like a security. Now, the key thing for you to focus on with respect to this, with respect to the conflict of interest provisions, is that because it is not a fund,
right,
you cannot treat it as you would a mutual fund for purposes of the exemptions.
Okay.
So it is not subject to the Investment Company Act of 1940. It is more like a security. So if any 2640 exemptions are available for real estate investment trusts, it would be the securities exemptions, not the mutual fund exemptions.
So these are sort of like, we could think of them almost like real estate stocks.
Yes, exactly, exactly. So what will they look like when you see them? It's like how to identify what this is. So we've given you just sort of a screenshot here of a real estate investment trust, Digital Realty Trust. And if you look at the top there, you can see that it trades on the New York Stock Exchange, and it has a ticker symbol DLR, which is like a security. It's a security type of ticker.
Right.
And you might say, well, that's not hugely helpful. So I can say that further, if you look at the description that they provide also on that same page with those details, those financial details, you'll see that it says explicitly, Digital Realty Trust is a real estate investment trust. So there are several different ways that you can distinguish a real estate investment trust from just a regular old real estate mutual fund, okay? So then what does a real estate mutual fund look like? Well, a real estate mutual fund is a mutual fund, okay? So it's going to have the same characteristics of any mutual fund. It just happens to be a mutual fund that invests in real estate or real estate companies. So as we said, as with all mutual funds, it has to be an investment company that's registered under the Investment Company Act of 1940. So that's the one way to know that it's a mutual fund as opposed to a real estate investment trust.
Okay.
Okay. So let's give you a screenshot of that, of what that looks like. So T. Rowe Price Real Estate Fund, as you see at the top, it's a mutual fund. It's listed as a mutual fund, and it has a mutual fund ticker. So that's that 5-letter ticker that ends in X, which is typically a...
Yep. I think the SEC doesn't let you have one of those unless you are indeed a mutual fund. So
exactly. So whenever we can see this and we see that it's a mutual fund, we know we're not dealing with a real estate investment trust. We're just dealing with a real estate mutual fund.
Okay.
Now, I want to remind folks that we have a legal advisory out on this from June 30th, 2015, which talks about the difference between a diversified and a sector real estate fund. And one of the key takeaways of this, legal advisory is that real estate investment trusts are not going to be subject to the mutual fund exemption, so they're not funds. So when we're talking about this advisory, it's not addressing real estate investment trusts. It's addressing itself to real estate funds. The other takeaway with this is that just because you have a mutual fund that invests in real estate or real estate companies doesn't in and of itself make it a sector fund, okay? And I know that may seem a little sort of confusing to folks, but what OGE tries to distinguish in this advisory is that you can have a real estate fund that will be investing in real estate companies across different industries or in geographic locations. So one of our indicia of whether or not it's a sector or a diversified fund is it investing exclusively in real estate in a given industry?
Okay.
Or in you know, or in a single country other than the United States, for example. So we want to be looking at sort of like, what are the real estate investments that the fund is making?
I see. So if we had a real estate investment fund that specialized in, let's say, hotel properties, that would be sector, because those kinds of properties are all in the same business sector.
Right.
But if we said we seek properties that are going to experience, or in markets that we expect to experience capital appreciation over the next 10 years, that might be diversified.
Yes, because it might go across industries.
Right.
And I'm going to give you a specific example in a minute of a description, so that we can sort of take a look at that more closely. But I wanted to cover one other additional type of thing that you might see that will also qualify for, or potentially qualify for the mutual fund exemptions, and that is an REIT ETF. We got an MOUSE. we got a lot of letters going on here. Okay, so a REIT ETF is an exchange traded fund. Okay. And they invest the majority of their assets in equity, REIT securities, and related derivatives. Okay, so it's an exchange traded fund. So it is a fund. It's a fund, but it's investing in basically in REITs.
It's a fund of trusts.
It's a fund of, yes, it's a fund of real estate investment trusts. If that isn't making your head go wobbly, then you know
it's pretty meta.
It is pretty meta. So what does this look like? Okay, so if you look at the ETF, an example of one, we have an iShares. Again, many letters here, FTSE, NAREIT, Resi Index Fund, okay? And while this looks like a security, Patrick, you want to explain how, even though exchange-traded funds look like securities and they have ticker symbols like securities, they are actually treated as mutual funds?
Yeah, basically an exchange-traded fund, my understanding is it's a fund, but it trades like a stock. So when we have mutual funds, they get a price and are traded at the close of the session each day. Exchange-traded funds trade on markets throughout the day. So you can buy it in the morning, sell it in the afternoon. It's got a spot price that changes throughout the day. You see the real-time price here is at 10:12 a.m. Eastern Standard Time. So they're basically funds, but for the convenience to make them more useful to more investors, they're traded on an index, just like a stock.
Okay, so let's keep this straight then. We have REITs. The actual REITs themselves, the real estate investment trusts, are basically securities, and they trade like stocks, and they're treated like securities for purposes of 2640. Okay.
So the trusts themselves are sort of like real estate stock things.
Yes.
Okay.
So now when we're dealing with mutual funds, a mutual fund can be invested in the real estate sector,
right?
But it can still be a sector or a diversified fund, depending upon whether it invests across the real estate industry or singularly in one industry of real estate.
Okay, so these are real estate mutual funds, basically. They're registered under the Act. We use the exemptions for mutual funds when we're looking at the funds.
Yes.
Okay.
And then we have this third category, which are exchange traded funds, which can invest in REITs, in the real estate trusts, but they are a fund, and they are treated like a fund. Even though they trade like a stock, they're treated like a fund for purposes of 2640 exemptions.
Okay.
And again, they can be either sector or diversified.
Okay. And actually, this makes sense to me, because when we look at exchange traded funds, they invest in stocks, right? So, and we understand that. We say it's a fund, and what does the fund hold? A bunch of stocks. So in this case, it's a fund. What does it invest in? It invests in a bunch of REITs, or it invests in basically real estate stocks.
Right.
Right. So in some ways, this is very similar to the securities we're used to dealing with.
Right.
The words are just a little bit different.
Yes.
Yeah.
Yes, exactly. So we said that in OGE's legal advisory, we say that just because something is focused on real estate, a fund that's focused on real estate does not necessarily mean that it's treated as a sector fund for 2640. So I want to take this iShares fund and look at its description. And if you look at, like it says, the index measures the performance. It's following an index, and it says the index measures the performance of the residential, healthcare, and self-storage real estate sectors of the United States equity market. So based on that description, Patrick, would you think this could qualify as a diversified fund, or do you think this looks like a sector fund? So it measures the performance of the residential, healthcare, and self-storage real estate sectors.
Well, if we extend our understanding of the requirements for diversification or being a sector, generally we say to be a sector fund, you have to focus in one sector.
Yeah.
And this looks like a few sectors.
Mm-hmm.
So it's not everything, but it's not just one.
Right.
So I think I'd be leaning diversified here.
I agree, because I think residential real estate is one industry, healthcare real estate is another industry, and self-storage real estate is clearly another industry.
That's right.
So
yeah, you'd be upset if you exchanged your house for your self-storage unit or vice versa.
Precisely. I don't think too many people would want to use self-storage as a residential real estate. So I think this is an example of one where it's a diversified real estate ETF.
Right. Okay.
Okay. So hopefully this has been illustrative for folks, so people get the sensibility about it. So again, just to reinforce that all of this guidance is in our June 30th, 2015 advisory. And just remember that this advisory really applies to diversified and sector real estate funds, not to real estate investment trusts.
Okay.
Okay.
Clear. Crystal.
Okay. Very good. Okay. So Patrick, I'm going to hand this over to Patrick now to talk about put and call options.
Yeah. So now that we've covered that very simple, straightforward topic.
Yes, let's talk about the one that's really going to
talk about the
drive you
complicated
crazy.
stuff.
Yes.
No, so we do want to talk a little bit about put and call options. And the reason we want to do that is because I think there's a lot of confusion around these. And there's a lot of confusion because there are a bunch of permutations. And options, I think, I find them hard to get my head around.
Mm-hmm.
And I really have to kind of slow down and think about how the transactions work in order to get me through the reporting process and to be able to understand how the conflicts review works. But if and until you are comfortable with sort of what happens when someone buys or sells an option, it's very difficult to kind of understand why the reporting is so complicated.
Exactly.
So we're going to try I think we've tried to do this a few times, but it's challenging. So we're gonna do a little exercise and see if we can bring some clarity to this concept.
And we have props.
We have props. So what is an option? It's a contract, and it gives the right, but not the obligation, to buy or sell a security for a price certain on or before a future date certain. So it's an option to buy or sell. It's not a security. You don't get any stock certificates. You don't get to vote. And it's a contract between two people that gives the right but not the obligation to buy or sell a security for a price certain on or before a future date. And we're going to do a little illustration to maybe help this become a little clearer. And the thing that's really tricky here is there are some important questions we need to ask ourselves. And the first one is, did the filer buy or sell the option? So I can buy an option. I can buy the right to buy or sell. Or I can sell the right to buy or sell.
This is one of those things where you need to like map it out.
You need a little chart.
Mm-hmm.
And then for each of those options, right, either the right to buy or sell that I have purchased or that I have sold, there are some other permutations. We have to find out if the option has been exercised. Right? Is it something that's come to fruition and the right has been exercised? They can be sold and they can be closed. So once I have the contract to buy or sell on a date certain in the future for a given price, I could sell that to a third person. I don't have to actually use or exercise the right. I can sell it, which is sort of like a trade, but it's really a person-to-person thing. These things don't trade on exchanges the way a stock or something does.
But it would qualify as like a purchase or a sale.
Yes, absolutely. It's definitely a transaction.
Okay.
But the thing you're buying is this contractual right to buy or sell on a date certain for a price certain in the future.
Okay.
All right.
My head hurts.
So we made a little chart
Mm-hmm.
that may or may not be helpful to you, but we hope it is. So in an option contract, you have two parties. One is the holder and one is the writer. The writer is the person who sells the option. The holder is the person who purchases the option.
Okay.
So if I'm the filer and I want to take some money and buy an option,
Mm-hmm.
I can buy an option to buy. And we call that a call.
Okay.
So a call option provides the right to buy And if I'm the holder, I buy that right to buy.
Okay. So in other words, like, so for a 278 filer,
Yes.
if they are purchasing an option,
That's right.
that would be considered a call.
That's one of the things they
One
can
of the
purchase.
things they can purchase.
Yes.
Okay.
So if I'm buying the right to buy, then I'm buying a call.
Okay.
I can also buy the right to sell.
Okay.
So if I buy the right to sell, we call that a put.
Okay.
And you're probably wondering, you're sitting there going, why would anyone want to do this? Right? Why does this make sense? And what is the purpose of these things? Well, in the case of a call, let's say that I thought the value of XYZ company was going to skyrocket.
Mm-hmm.
I think it's going to go up a lot. But the rest of the market doesn't think so. Mm-hmm. So I say, I'm going to go look at the option chain, and I'm going to see what it would cost me to be able to buy shares of XYZ company in 2 months' time for their current price, or something right around their current price. Mm-hmm. And I say, well, actually, for a few dollars a share, I can buy the right to buy 100 shares of XYZ company for just a few dollars on the share. And I think they're going to skyrocket.
So you're going to get a deeply discounted price on what could be a much more
valuable
stock later on.
If we get to the maturity date and I'm right, well, someone's just sold me the right to buy. So they either have those securities, so they have to go get them, and then they have to sell them to me at the price we agreed upon. So I can make a whole bunch of money on a relatively small investment. Basically, I get a hugely leveraged position. Mm-hmm. So that's basically what they allow you to do in the case of calls. In the case of a put, this is also sometimes called shorting. It's a short position. Mm-hmm. If I thought XYZ company was going to tank, right? It's going to go away, and I have a lot of XYZ company stock. I'm saying, I think their next quarterly report is going to be not so good. I don't necessarily want to get rid of it, but I want to protect myself a little bit against the downside. I might go look on the option chain and see what it would cost me to be able to sell those shares 2 months hence
at the
current rate. Mm-hmm. So no matter what happens, I know I can offload my shares for the price that they're currently trading at, or a price around there. Mm-hmm. And then if I'm right and the price tanks, well, I've protected myself, because my shares that I currently hold, I still have the right to sell them mm-hmm. at the price they are now. Mm-hmm. So that's kind of why someone would buy call and put options. Mm-hmm. So maybe we could do our little skit. How does that sound?
Okay, we're going to do a skit. We've got props.
Yeah, all right. So let's say, for the purposes of our exercise, I'll be the filer. Okay. All right. And in the first case, I think ABC company, their share price is going to pop. They're going through the roof. So I go out onto my broker's website, and I look at the calls. Okay. Right. And I say, oh, look, the right to buy 100 shares of ABC company in a few months at $10 a share, which is today's current price. Mm-hmm. Say, I want that. Okay. So today, what I do is I take my money, mm-hmm. and I say, I want that right. Okay. So I give you the right, and you get the money, and I get the money. Okay. So this is kind of the simplest version. This is kind of like buying a stock, right? Okay. So right. I've given you the money, and I get the contract. Okay. So I'm going to hang on to this. Okay. So in this case, for the next several months until the 20th of September, uh-huh. I have a big financial interest in ABC company, uh-huh. because I have the right to buy it at $10 a share. Uh-huh. And I think they're going to go through the roof. I'm going to make a lot of money on this deal. Uh-huh. And Cheryl's going to lose a lot of money. It's going to be great. Okay. And this purchase would be reportable as a transaction? That was a transaction. What we just did there, when I gave you the money and you gave me the contract, that's a transaction. Gets reported on your E and on your Schedule B. And also, this now is reportable as an asset. Right. Okay. This thing is an asset. This has value. Even if it's underwater, it has value. Okay. All right. And we're gonna show you in a minute here how to report. We just wanted you to get the concept kind of down right now. So I'm the buyer. I've bought the call. Okay. So I could also buy. I could say, you know what? I think ABC company is going to go the other way. I want to get a short position on ABC company. I have some shares. I want to protect their value. So I'm going to go out. I'm going to say I'm going to buy the right to sell in September. So I give Cheryl the money, and she gives me the contract, and now I have a contract, right? I have an asset, again, reportable as an asset, and also a reportable transaction has just occurred.
Mm-hmm.
But I hold this, and I have a financial interest in ABC company for the duration of the option.
Right.
Okay.
So whether your filer is purchasing the right to buy or is purchasing the right to sell, it's still a purchase, and it's still something that's reportable on their part, on the part of the form where you report other income and assets and income.
That's correct.
Okay.
So that's actually very helpful. And I think these are the kind of easiest ones to understand because, you know, basically it's like we're used to with other kinds of securities and investments, right? You give the money over and they give you the thing that produces the interest in the form. So where this gets a little trickier is there are some permutations that take place with those options. So let's take a look at this this first line here. So here we have an option that has not been exercised. So this is how we would report an option during that period where I hold it and it's still good.
Okay.
Right. So we have Grousler Inc. Call option. It's not an EIF. Definitely not. It has a value. So we're going to assume that this is in the money. And in the money basically means that with a call option, the current share price is above the strike price.
Okay.
So in our case, the strike price is $10. Contract is for 100 shares. So let's say that ABC company went to $11 tomorrow. The value of that option, it would be $100 in the money because I'd have a dollar per share.
Okay.
So here we can estimate the value of the Grousler Inc. call option, which again is the right to buy at a future date. And so we report it sort of just like any other asset. What happens if, in our case, ABC company goes to $8 for a while and I have a call option?
Oh,
it's worth sort of it's negative $2 a share.
Okay, so you were counting on it going up and it went down.
Yeah, you know, they've not come out with their good report yet.
Okay,
right? You know, we're waiting around for the surprise.
Okay.
So that's tricky. So, you know, we multiply -2 times 100 and we get -200, but that doesn't seem right. Because, you know, clearly I have a financial interest, and actually someone won a Nobel Prize for figuring out how to value these things. But the way we handle that is simply by reporting the terms of the option. So this is an out of the money, not exercised option. So we're during the period when the right is good. So here we've reported Grousler Inc. call option, value not readily ascertainable, 100 shares, strike $7, and the expiration. So basically the things that are the terms of our option we've just reported in the description. Again, it's obviously not an EIF, that's not applicable. We can leave the value blank and there's no income here.
Okay.
So we've just indicated that the value is not readily ascertainable.
Okay, so the strike price is something that you can know, so that you would report.
Yeah,
right?
the strike price is known at the time you purchase
Gotcha.
purchase the option. So this is an acceptable way of reporting.
Okay.
And with purchase options, we have a third possibility. And that's an option that was sold, right? So say I buy my my put option, the share price dips a little bit. I say, you know what, I'm going to get out of this position and make some money, right? So I'm going to take some money out. So I bought it for $1,000. I can get rid of it for $1,200. I'm going to take my $200 and run. So here we would indicate that we don't currently have a value because we have sold the asset.
Right.
But we have to describe it and we have to report the income. So the income is going to be a capital gain in the event you sell an option. And then we'll indicate whatever the income amount is. So that would be the difference between the price you paid for the option and the price you sold it for.
Okay.
Does that make sense?
Yep.
And there's another possibility still that we'll look at in a minute.
Okay.
All right. So that's purchasing put and call options. And it may be helpful just quickly to mention that incentive stock options that people get from previous employers are generally call options.
Okay.
Generally speaking, they get the right to buy at what is expected to be a favorable price in the future. And it's a way of providing them sort of further equity interest in the performance of the company. So they're frequently used as incentive options. So you can use the guidance for call reporting in those cases.
Well, you sure wouldn't want to short sell your own company,
Yeah.
I don't think.
No, that would be an interesting executive compensation package.
It's
right?
kind of like incentive in the wrong direction.
Yeah, well, that's probably not legal. So yeah, that's something to keep in mind. So that's the fairly straightforward example
Okay.
of what happens when you buy options, either puts or calls.
Okay.
All right. So let's look at the other possibility. So in this case, I'm still going to be the filer.
Okay.
But
I got the money
But
now.
instead of having a bunch of money and wanting a bunch of rights,
Right.
I'm going to write some options.
Oh, okay.
And then get some money.
Mm-hmm.
So that's tricky. So let's start with the call. Okay. So I think that the value of ABC company is going to tank.
Okay.
And Cheryl
sucker
thinks the value of ABC company is going to skyrocket.
She knows nothing about.
So I'm going to say, you know what, Cheryl, I would be happy to take that wager. And
P.T. Barnum here, and
you
relieve you from your
the right to buy
okay
100 shares of ABC company at $10 a share in September.
Mm-hmm.
And I will just need from you an awful lot of money. So I get the money and you get this.
Oh, yay.
All right. So it would seem, right, logically,
mm-hmm.
that I shouldn't have anything to report here, right? I got the money. You got the thing. I don't have a
shaft. I think
I don't have a contract, but I do actually, because what we have is an agreement.
Oh, okay.
I have an ongoing obligation to you or anyone you sell this to until September to come up with those shares at that price.
Oh, okay.
So I've got the money, yes, but I have an ongoing obligation. So if I'm wrong and you're right, and I don't have these shares right now,
then you're gonna have to go out and get them.
The price goes through the roof. I'm gonna have to go get them and sell them to you for $10 a share, even if they're trading at $20 a share.
Got you.
And then that would be very bad for me. And I hope I got a lot of money on the front end. So that's definitely a financial interest, right?
Right.
I have a huge interest in what happens to ABC company.
Got you.
Until the end of September, or until the end of September, basically.
Right.
So we need to capture that somehow.
Right.
Right. So I'm the seller in this case, but we still have a reporting issue here.
Mm-hmm.
And I could do the opposite. I could think that ABC companies can do very well.
Mm-hmm.
And one thing I could do is go buy some calls, or I could sell some puts.
Okay.
So I'm going to sell you a put now.
Okay.
So now you have the right to sell to me.
And you would have to buy it if I exercise that right.
I would have to buy them at that price now.
Gotcha.
So again, I have a big interest in ABC company.
Gotcha.
So we're going to have to figure out how to report those things.
Okay.
So
everybody with us?
Everyone, yeah, that's
okay.
You can be the buyer or the seller.
Yeah.
Of a call or a put.
Okay.
So let's see how this plays out. All right, so here we have an open position. It says Widgets Unlimited, open position for written put option, 100 shares, strike, $7, expiration 5/2016.
Okay.
Basically, we've just indicated here what my agreement is.
Mm-hmm.
And that's perfectly adequate, right? That's actually great, because we understand sort of what my financial interest is. I certainly am interested in the value of Widgets Unlimited. Nothing's happened yet, right? I've taken my dollars, the position's open, and we're waiting to see what happens, whether you decide to exercise or whether you don't, or whether the option expires without value. We're not sure what's going to happen, but we know that our filer has an interest in the share price until it closes.
Gotcha.
So we've provided the relevant information here. So that's an open position. And here's a closed position. So this is something, the expiry date has come and gone.
Okay.
Okay. So in this case, I wrote a put for Xylophone Technology Corporation, XYZ company. It no longer has value, but I received a capital gain, so I have to report the income that I've received.
Okay.
Okay.
Mm-hmm.
And finally, we have a case where we came into ownership of the stock. We exercised the right to buy.
Okay.
And we bought some stock. So if we own call options and we exercise the right to buy and we buy those shares, we report those shares like any other stock. There's nothing special about them, but we have to remember to report them.
Okay.
And the purchasing those shares will be a transaction.
Oh, okay. So when you exercise the option, you're actually purchasing the shares, so that does require, that is a reportable transaction.
Yes, if you exercise it and then you make the purchase, and you should report it just like any other stock, just like you bought anything else.
Okay.
Sometimes people will use options to purchase stock at a favorable price. You know, they'll see an opportunity. They think, you know, there's a lot of volatility here, so I'm going to use an option to sort of to kind of name my own price.
Okay.
But then those assets that we purchase as a result of exercising, those are reportable just like any other stock. Nothing special about them. So that was simple, right?
Oh.
Yeah, there are only like 8 or 10 permutations, right? I could be the buyer or the seller of the option. The option can be the right to buy or sell. The position can be open or closed. It can be underwater or in the money. So there are a lot of these things. So really what I like to do is just really sort of sit down and think it through and you know, sort of answer all those questions. So what about conflicts of interest?
Wow.
So I think we've seen that in the case, no matter which end of the contract you're on, you have an amplified interest in the performance of this company.
Right.
Right. The share price can move just a little bit and it has a huge effect on your financial circumstance.
Well, and you're sort of wagering on that too. I mean, the very act of like engaging in calls and puts, really you're anticipating or trying to anticipate a movement in the price, right?
Right. So, and it's sort of a leverage position. So it's bigger than simply owning the shares. Right. It's amplified.
Right.
So a little movement in the share price can move the value of an option a great deal.
Right.
You know, on or around the strike price, the difference between being just below and just above can be, you know, the difference between having something that's a worthless piece of paper and something that's worth quite a lot of money.
Right.
So we have an amplified equity interest in the companies that we've written options on, or the securities that we've written options on. And these things aren't registered or traded like securities. And if you recall from our regulations, when we look at the exemptions available for securities, the first thing is it has to be traded on exchange.
Right.
These contracts are not. These are contracts that are written between between investors, and that transaction is mitigated by, you know, a brokerage firm or a, you know, a financial institution, but there's not a market. They don't get ticker symbols.
Right.
So we don't get any exemptions here. So we have an equity interest the same as we would with a stock, but we don't find any relief in 2640.
Okay.
So clear as mud.
That's I mean, I you know, but it does make sense. I mean, you do have an amplified interest, you know, in the value of the stock. And so we have to treat it as we would similarly to a stock interest, but, you know, it isn't technically a security and you don't yet have actual securities. You have, you know, it's a contract to buy or sell. And so
once it's realized, once we have the securities, if they qualify for the exemptions, we can use them. Right. But during the period where we have an open position or an option that we hold that's not been exercised or sold, that thing itself produces an equity interest. Right. The same as stock would. But for that contract, we don't have an exemption available. Gotcha. So in some ways, it's a simpler conflicts analysis, but it's more stringent. Yes. And you know, divestiture is typically if you have a potential conflict, you know, that's you know, you're either looking at recusal or divestiture. Those are the possibilities. Waivers would be tricky. Okay, so those are put and call options. And you know, I think if you find yourself frustrated with these things and trying to sort of think it through, you're not alone. They are complicated. I usually have to sit down and draw a picture and say, okay, so this is this and this is that, and that's all fine. But our guidance in the reporting guide is really good. And once you figure out what it is that you're trying to report, the reporting actually follows pretty straightforwardly. But if you don't know, if you can't sort of figure it out, then sort of groping around in the dark. So those are put and call options. I just want to talk about capital calls because these are something that we've had a few questions about. And these actually really are simple. So a capital call is a legal right stemming from a contract which allows an investment firm to demand money that investor has agreed to contribute. So we see these with investment companies. They're raising capital over time, and maybe they say, you know what, you don't have to come up with all $1 million right now, right? We're going to set up a schedule or a proposed schedule where we're going to ask for contributions periodically over time. And for our purposes, that's a liability, right? That's something that has to be reported as a liability because it's essentially a debt. There's an obligation of the investor to make good on those payments as they're called in by the investment firm. So when you see a capital call, you say a kind of panic. I say, that's money that an investor owes to someone who's going to invest it for them over time, and it's a liability. So we report it kind of like any other liability. We say Elm Street Investors LLP. What is it? It's capital call. How much do we owe? When do we incur it? Is there a rate, if any? And what is the term? What is the schedule of likely payouts? So that's really straightforward. But the thing that's not so straightforward is often these things are attached to pooled investment vehicles. So if you see this, you want to make sure that you ask if there are associated assets, right? Is this person currently an investor in Elm Street Investors LLC? Should that be reported? Should the underlying holdings of that vehicle be reported? Are they reportable? All those questions you ask when you see private equity companies. So the capital call itself, pretty straightforward.
But it might be an indicator of other things that need to be disclosed.
It's almost always an indicator that there's probably an investment vehicle associated with it that should be reported as an asset. Okay.
Very good.
All right.
Okay.
So two really hard things and a fairly simple thing, and then back to hard things.
This one isn't actually, I don't think this is quite as hard as people seem to think it is. And we've gotten quite a few questions on this as well. And this is typically coming up from folks who are coming in from consulting firms and law firms. And I pulled this right out of the 278E guide. So, I mean, I'm not telling you anything you can't find on your own, but I think it bears, it's worth covering just to sort of clarify a little bit of what we see here. When we say in certain rare cases, we do really mean rare cases. We don't often see situations that actually meet the criteria that we think are necessary in order for someone to be allowed to not publicly disclose the identity of clients that they had that were for which they provided services in excess of $5,000, and that's where this comes up is in the income for services sort of thing for clients. And typically we say in those instances where you meet the criteria, you still sort of have to specify the reason why the clients have not been disclosed, and then you have to indicate how many confidential clients have not been disclosed for each of the reasons that you specify. And for presidential nominees, it's worth noting that any non-disclosure has got to be approved in advance by OGE. So if you're dealing with this in the case of anyone who's being nominated to a presidential appointment, you really need to clear that with OGE before you accept that's truly a non-disclosure situation. So let's talk a little bit about the criteria. What are the certain rare cases? We say that there are three that we describe, which are that clearly if you've got an identity that's protected by statute or that's under seal or under court order. Clearly, those things are going to trump the Ethics in Government Act requirement that they disclose. We rarely, if ever, see this. If disclosure is prohibited by a rule of professional conduct, so if for whatever reason there's some sort of professional responsibility rule out there that would result in the person being reprimanded by their professional association or professional licensing body, then clearly that would trump the disclosure requirement. And then finally, and this is the one I think that we always bump up against where folks sort of pursue this, there's a written confidentiality agreement that expressly prohibits disclosure of the client's identity. Now, I think that some people sort of think that that's the get out of jail free card, but I wanted to say that that it isn't always necessarily. So what does not qualify? So a client is not going to be deemed confidential merely because the filer believes that the client would prefer to remain anonymous or not be disclosed. And neither is the mere existence of the privileged relationship sufficient to preclude disclosure, unless you have one of the other conditions that I just walked through here a second ago, one of those 3 conditions. And we have a diagram on this, an advisory back from April 7th, 2006 that talks about this in a little bit more detail as well. So I would, if you're running up against this, I would recommend reading that particular advisory. But I think one of the big things that I know I have personally seen in some questions that I've gotten, and this could be the thing that mitigates many confidentiality agreements that you might see. And you would want evidence of it. I think you want to see the confidentiality agreement if one exists, and that's the basis upon which someone is suggesting that they don't have to disclose their clients. We've been seeing language in some of these agreements that reads, for example, that confidential information that is subject to the confidentiality agreement does not include information legally required to be disclosed. So a lot of these confidentiality agreements will not reach to situations where there is another law that would require that disclosure. So we believe that the Ethics in Government Act is a legal requirement to disclose, and it is. It's a statutory requirement to disclose. So if you run across confidentiality agreements that contain this type of language where it basically says this does not reach to any information that is legally required to be disclosed, well, EGA is the legal requirement to disclose. So again, if you don't struggle with this, if it's something that you're experiencing with any of your noms or with any of your employees, do come to us, and we can certainly help you walk through and see whether or not the evidence that they provide meets one of those 3 criteria. But just to give you sort of a heads up about where OGE comes down on these. With respect to like non-disclosure, again, I just wanted to remind everybody, we also have a legal advisory on pooled investment vehicles from September of 2014. And this talks about, the financial disclosure requirements for pooled investment funds. And this covers any pooled investment fund. So anytime you have any fund that's got a variety of investments in it, and this will also reach to hedge funds, it reaches to private equity sort of types funds. I think the key takeaway in this particular advisory is you really should make sure that you can't reach accepted investment fund, the definition of accepted investment fund, before you go through the gyrations of being worried about whether or not there has to be divestiture because they can't disclose it on their public financial disclosure report, the underlying holdings. Because oftentimes with hedge funds and private equity funds, there isn't the filer themselves does not necessarily have access to the information about the underlying holdings. And I don't want to go into this too deeply right now, because a lot of these types of investment vehicles are one-offs, and they're kind of unique, and you really need to kind of look at them on a case-by-case basis. Right. So to the extent that we have any general guidance, the best general guidance we have is in this particular legal advisory.
And if you take a look at this, you'll find that this is more of a process document than a document that gives you dispositive answers for any given asset. So really it's a lot of things that we have to consider, determinations that have to be made about the individual investment company to determine what, if any, reporting requirements there are and how we handle the conflicts of interest. So it's really a guide to get through the forest rather than a solution to the forest.
Well, but in that vein, it's actually very helpful, because this is really about a process, and it is a matter of sort of process of elimination, and it's kind of like, is this present? E.g., can you get to EIF? Well, if you can get to EIF, then at least the disclosure piece you don't have to worry about. If you can't get to EIF, then we talk about, is the inability to disclose alone sufficient to require divestiture, or are there alternative ways of provided that there aren't conflicts. So there's a conflicts process that they want you to go through as well. So it will walk you through the things that you need to consider, and give you at least a starting point when you're running up against these things.
Yeah, they're just a lot of conditionals.
Yeah.
We just really have to, is it a this or is it a that? If it's this, then we have to think about this, and if it's not, then so on and so forth. And it's a process that we go through every time, and there's not a shortcut.
And the next thing I want to toss this out here, and I'm not trying to be heavy-handed, so I want to sort of like I want to sort of caveat what I'm about to say by saying I am not suggesting that, that we all immediately run to making referrals to the Department of Justice anytime we have a filer who is who's reluctant to disclose things. But I do want to remind folks that per the Ethics in Government Act, and you can find this referenced in 5 CFR 2634.701 as well, in instances where you have a filer who is willfully failing to either file a report, and I think that's where we most often see these referrals occurring, is when you have someone who willfully fails to file like an entire report. But it also extends to when an individual has willfully failed to file information that's required on such report, that there is the ability to refer that to the Attorney General for, relevant penalties to be conferred. Now, again, I'm not saying this as a way to say everybody should run out there when you're having some reluctance, or if you think someone is not providing information and immediately refer them to the Attorney General. But I do think it's worth our while to remember that that is something that is available to us. That if you have a real, complete, recalcitrance, that it is something that you can at least suggest to someone that, a willful failure to provide information that's required under the statute can result in a referral to the Attorney General. So again, I would tread lightly in this area, but I think it's always worthwhile for us to know what kind of,
and to remember,
tools we have.
These are legal requirements.
Right.
Right. This isn't, it's not optional. The Congress has determined that this is information that must be disclosed. And it must be disclosed in accord with the Ethics in Government Act, and there are consequences if you refuse to.
Right.
Yeah.
Okay, so now we're on to inter vivos trustee positions. There you go, Patrick.
So now we can talk about estate planning. So this is a sort of a purely reporting thing that we've started to see more often, and it's really just a question to add to your list of typical questions, and it deals with inter vivos trustee positions. So the first question we have to ask is, what is an inter vivos revocable trust? And basically, it's an estate planning vehicle that can own assets during the trustor's lifetime. The purpose is generally to make assets more easily transferable to the beneficiaries without the encumbrance and expense of probate proceedings. So it really is an estate planning tool. The goal is to streamline the distributions of assets upon the death of the trustor. And the way we often see these is spouses will set them up for each other. So in the event that one or the other spouse passes, the other spouse is the trustee of the inter vivos revocable trust and is able to make the distributions without going to probate. The reason people often overlook these is because it really, from a practical perspective, is something that you establish during your estate planning process. It's kind of an alternative to certain functions of a will. It may be, used in conjunction with, some other estate planning vehicles. And once it's done, it's kind of just done. You don't really have to think about it. There aren't duties of the trustee that they have to regularly discharge, except upon the death of the trustor. So this is what we want to do. Filers don't think of them as positions because, they don't go to work and punch a clock as the trustee of the spouse's inter vivos revocable trust, or another family member's inter vivos revocable trust. And also they can report the assets on Part 6 without designating them as being held in a trust. Because it's very often that most of their assets, the trust says, all my assets are held in this inter vivos revocable trust. If I were to die, this person who's the trustee will distribute them to these people. So, really it's an estate planning vehicle. So people don't think of them as being held in a trust because they can do whatever they want with them during their lifetime. So people forget about this. So the questions that we probably want to ask is, have you established one of these, or has your spouse established one of these? Are you the trustee of any such trust, either for your spouse or another person? If that's the case, the position needs to be reported. Are the assets of the trust reportable and reported on Part 6? So if they've set one of these up and the assets belong to them, they need to be reported. And it's always good to ask if you're the trustee of any other trusts, because these are frequently overlooked. So this isn't a huge deal. It's not sort of earth-shattering stuff, but it's something that we see people forget and they don't think of, and I don't think there's any malice in it at all. It's just, you know, when they sat down with the attorney to set up their will, they establish these things and then try not to think about it again. Because there's not much to think about, so they forget to report the positions. So it's helpful to ask.
Okay, very good. Okay, and finally, we're going to talk briefly in the time remaining about temporary part-time consultants. I always encourage folks, when you're dealing with temporary or part-time employees that are going to be serving, and you anticipate that they're going to be serving for 130 days or less, that you look at our special government employee legal advisory that we issued back in February 15th of 2000. This is sort of the seminal guidance document on special government and employees, and it completely covers the waterfront on everything you need to know and then some about how to determine if someone's an SGE, about if they are determined to be an SGE, what regulations apply to them and how. And it literally walks you through all of the various regulatory and legal authorities and discusses to what extent those apply equally or in a differential way to special government employees. So I know that this came up for folks, I think, particularly right after the transition began, when we had beachhead teams and other transition teams coming in to work on a part-time or temporary basis. And I think the thing that you need to remember is that if they are employees, if they are considered to be employees, then the key to figuring out like how to treat them is to start out by figuring out whether or not they're going to be special government employees or full-time employees. And again, the 130 days of service is really the marker for whether or not someone's going to be a special government employee or a full-time employee. And that estimation has to be done at the time that they're appointed. And once you make that estimation at the time they're appointed, that sticks with them for the remaining 365 days until such time as they either get a new appointment that's to a full-time position, or you come up on a reappointment for their temporary or part-time position. The SGE memo talks about day counting and what constitutes a day. And it does talk about how you go about making a determination that someone is a special government employee as opposed to a full-time employee. The next thing I know that comes up for folks a lot is the question of how do we know whether or not they're filers? So the question about filing is going to be kind of like a 2 or 3-fold question. One is, do they meet the criteria for public filing, both through the actual amount that they're paid, but also the number of days that they're anticipated to serve in those positions. So for part-time and temporary employees, what you need to do for those guys is to annualize whatever pay they're getting. And if that annualized pay falls within the threshold for public filing, and they're anticipated to serve more than 60 days in that position, then you would have them file a public financial disclosure report. If for pay reasons or day counting reasons or whatever, they're not gonna fall within the ambit of the public financial disclosure reporting requirements, then they are likely going to be required to file a confidential financial disclosure report. Again, I'm giving you a very shorthand version of this. The advisory that I just referred you to is much more detailed. And also our regulations as well at 2634 will go into this as well. As I said, it will also discuss the application of the various ethics authorities. The only thing that it won't discuss are pledge questions. But one thing I think it's important for everybody to recognize is in the documents that we've issued, the legal advisories about the application of the new ethics pledge. In many instances, the new ethics pledge mirrors the old ethics pledge, and the advisories that we issued with respect to the Obama ethics pledge will apply to the Trump ethics pledge. And one of the things that we believe continues to apply is that the definition of appointee for purposes of the pledge does not include a special government employee. So special government employees who are appointees would not be subject to the Trump ethics pledge. Okay. So I think that's all we have for today. Patrick?
No, I think that was quite the slog.
It was the slog.
And thank you all for staying with us. And, you know, we hope you found some of this useful. And when you see some of these issues come up on your public financial disclosure reports, you'll have at least some comfort or some rememberings that there's guidance that can help you. You know, go back and always watch these presentations. And also, you know, do use the guide.
Yeah, on our website, we have the 278E guide, and we have some other guides that can give you some really useful information to assist you in your public filing.
You know, especially if you're not doing this day in and day out, you know, sort of doing it sporadically, the guidance is a really good place to start. And of course, you know, we're always happy to help you out, either work with you as a nominee reviewer or as a desk officer. So, you know, we really appreciate your attention to these matters. We hope you'll join us next Thursday for a presentation on some of the pledge guidance. And also, as always, we'll send you a course evaluation. Let us know what you thought. And if you have ideas or things that are sort of pressing needs for your own development or things you feel we need to address more thoroughly, let us know.
Yes.
You know, we're not in a great resource place right now. We're a little busy here, but to the extent that we can and make your lives easier, we're going to try, and we'll get there eventually.
Yes, absolutely.
Excellent. Well, thanks, Cheryl, and thank you all, and we'll see you next week.
Thanks, everyone.